right now, we'll bring you African business stories, even as we tell you that Nigerian banks are increasingly relying on costly short-term commercial papers to address liquidity challenges as the Central Bank of Nigeria enforces stringent cash reserve policies. But this actually forms the crux of our conversation today, even as we understand that this move comes as banks struggle to attract deposits amid rising costs imposed by the central bank's monetary tightening measures. And as of January, the CBN had mopped up 26.6 trillion naira in liquidity after raising the cash reserve ratio to 50% in September 2023. So even as we continue to look at the headlines this morning, looking at very important situations in Nigeria's financial space, we're being joined by Ayokunle Olubunmi, who is the head financial institutions ratings at Agusto Co, to discuss this very important matter. Thank you so much for joining us on the show.
Good morning, Likon. Thank you for having me.
All right, so let's start this way. At the last MPC meeting in February this year, the interest rate was retained at 27.5%. Asymmetric corridor was plus 500 minus 100 basis points. Cash reserve ratio was about 50% for deposit money banks and 16% for merchant banks, while liquidity ratio was at 30%. Now, is this the bane of the liquidity squeeze that we are seeing?
I think I agree with you, right? It's the CBN currently is trying to fight inflation, and their strategy is to try and even reduce the volume of funds that we have in circulation. And I think even what we can say is that things could have actually been worse because, like you mentioned, all the parameters were written at the last MPC meeting, largely because the new inflation numbers that came in just 1 or 2 days before that showed a decline in inflation. Well, can we call it a decline? Basically based on the new methodology of the CPI. But this has actually been what we've been seeing. Of course, the banks are actually affected. It's not easy having like 50% of your deposits sterilized with the CBN and earning no interest at all.
Well, let's look at these issues from the different areas that we have outlined. Now, the standing lending facility rate 2, which is said to be a key instrument for short-term liquidity management, according to what we understand, stands at 31.75%. So really, can banks actually manage their short-term liquidity needs well? And what does this mean for the cost of funds and overall stability?
I think for banks now, I think this is a period where a lot of banks treasurer need to show their prowess and their skills. So it's now you need to be able to manage your asset and liability very well. Let's not forget that for banks, they are in the game of margins, meaning that what they are doing is financial intermediation, taking funds, right, and also even lending out. So it's not only it's against how much rates that you are getting from the from the funds, right, the cost of funds. But you also need to also look at the cost of even the interest income, right? The income that you're getting, the pricing of your assets, right? So for most banks, you must be able to balance how much interest rate, what's the interest rate that I'm paying on the deposits, the various sources of funds, and even what am I even demanding for those that I'm giving funds with. And like you mentioned, what we've seen also is that banks are trying to get innovative to try and see what they can do. On one hand, to try and even reduce the cost of funding, trying to look for relatively cheaper sources of funds, and also looking for high yield assets where they can actually even get significant income, such that at the end of the day, the margin is positive and healthy.
Well, the Central Bank of Nigeria actually deemed it fit at the time, to take a tough stance on cash reserve ratio to control the amount of physical cash in circulation that was around, I think, 97% at some point. So would you blame the Central Bank for taking that decision and, of course, retaining the parameters at the last meeting?
I think it's the decision of the MPC was actually even logical, and but nobody was surprised when we heard what the CBN is actually doing, because that's the right thing to do currently during that particular period when you are seeing inflation going almost going through the roofs, right? Money supply is also increasing. But I would say that the good news is that it seems as if things are gradually getting better, because based on the last report, the volume of money in circulation has actually reduced to an extent, based on the new inflation numbers, that is based on the new CPI, right? We've seen a gradual reduction in the inflation rate. So the expectation is that probably now they can start thinking about even loosening things a bit. And even if you look at the last auction held, right, for the treasury bills, we've seen that, just although marginal, right, a gradual decline in yield. So probably maybe we will start seeing things getting better. So we can say that, look, the worst part, we are gradually getting past the worst part of the liquidity squeeze.
Okay, so I mean, you're saying it's going to get better. We understand the standpoint of the Central Bank of Nigeria, jacking up the CRR and banks having to get stock with half the deposits in a vault that can't be touched. But then, is it wiser now for these banks to now opt for short-term commercial papers?
Yeah, because I think it's a very proactive way for the banks. It's a bold move for those that have actually even done it. Because let's also put it out there, is that there's also the perception by a segment of the investment community that, as you see banks, if you see a bank that is deep going too much into the commercial paper space, it could mean that they're having liquidity issue. As the other, some people have that particular perception. So what you see is that some banks generally are very reluctant in even tapping that source of funds. But based on the current reality, although it might look as if, if you are looking at it just purely, it might look as if commercial papers are more expensive. But when you look at it deeply, they are way, way cheaper relative to deposits. Because, for instance, although commercial papers might be giving you like 22%, deposits might be taking 18%. But let's not forget that those deposits, half of it, you don't even have access to it. So effectively, the cost of the fund is actually even double. Let's also not forget, like, you have the NDIC premium and some other premiums that you have to pay for, such that it will further increase the cost of that particular funding source. I think another reason why commercial papers are getting more attractive to the banks is that for deposit, the customer can come the following day for the funds. Even if a customer is saying that I'm giving you fixed deposit or term deposit for a year, you can wake up the following morning and ask him for his fund. The worst thing you can do as a bank is to say that I won't pay you interest. You can't say that you won't give the customer the principal. However, if you have commercial papers, right, issued that the tenor can be as long as 270 days, right, you know that you actually have those funds locked for you at the bank. If the investor needs his funds, all you have to do is to go to the exchange and even try and even trade that particular paper, the instruments that you've issued to that particular customer. So for most banks, I think it's a bold way of even raising liquidity and even manage the current situation that we find ourselves. But however, like I mentioned, banks are relatively very careful when it gets to tapping into the commercial paper space.
Yeah, talking about being careful, I mean, they say these commercial papers with the high interest rates eat into bank profits when there are other viable funding tools like the certificates of deposits. Let's do a comparison here.
Okay, because if you look at it now, for the deposits, right, either you call it the different types of deposits, it will attract the cash reserve charges by the CBN. So meaning that for a commercial bank now, right, no matter how much you rate, once it's deposit, half of it is actually sterile. You can't lend it. You can't earn anything from it. However, whatever you raise from commercial papers, it is excluded from your CRR computation. So that means that it doesn't even attract CRR charges. So it also means that you have the funds 100% to lend, right? To lend out, to give out to customers, to buy some assets, and for you to even get more income from it. So you notice that effectively, you realize that the cost of even those deposits are way, way higher compared to the cost of the commercial paper. Although the stated interest rate might look a bit higher, but if you look at the effective cost, by the time you factor all the other implicit costs, you notice that deposits are getting much more expensive. Let's also not forget that for banks, there is a limit to which you can actually even raise the interest on loans. Because after a while, you're going to see a default. Because customers can't just be working for the banks. You can't be charging 60% interest rates, right, on loans that you're giving out. So that's why a lot of banks are focusing on the funding sources. So like I mentioned earlier, right, what you see is that the commercial papers are way, way cheaper when we are looking at the total cost of those sources of funding. relative to the certificate of deposits or fixed deposits or other kind of deposit that the banks even actually will get.
Okay, so if that is the case, and we are actually talking about, ensuring liquidity for the financial sector, what if the CBN suddenly, shifts the corridor to a more balanced option, like around a plus 200, minus 200 basis points, and maybe gradual reduction of the cash reserve ratio to about 40%? Maybe that would help the banks in this case.
Now, like you mentioned earlier, the focus of the CBN is actually trying to moderate inflation. And one way you can do that is to reduce the volume of funds you have in circulation. If you reduce the volume of funds that you have in circulation, the effective demand will reduce and inflation will actually even reduce. However, if the CBN suddenly just reduce the cash reserve, reduce the asymmetric corridor, what you see is that you're actually even going to have a significant increase in funds that is available in the economy. And that can actually have adverse impacts on inflation. And remember, we're already complaining that inflation pressure actually very high. If it's getting higher, you all know that disposable income, right, will actually even the effective income of consumers will actually reduce. It have various impact on the exchange rate. So that's why you see also that look, the CBN is also very careful, and they also need to be very careful about this. Yes, you might want to lose it, but you need to be sure that the economy can absorb the additional funds that will be coming in without having a significant inflationary pressure. Else, you notice that the essence will be defeated because if there's a lot of funds in the market, right, although you are declaring good huge profit, but the profit is being eroded by inflation. So it's a balancing act for the CBN currently now.
Hmm. So how do you suppose that depositors will be feeling about this now? I mean, banks are desperate for cash and are offering high interest rates to attract savers. Inflation, like you rightly said, 23.18%. So even with an 18% interest rate, one would think or, see that their money might just be losing value.
Yeah, I think this is a period in which investors need to also think carefully, right? Currently, we have inflation in the 20s, right? You see that the effective interest rate on deposit is like less than 20%. So I agree with you definitely that what you have is negative interest rates. And that's why to an extent you are seeing some pressure on the currency because you see that, look, right, if I can't get real returns in Naira, right? In dollars, you notice that you still have some level of a level of real returns. But what you also see, investor is also trying to also balance the portfolio. So what you see that you have some depositors, you have some funds with the bank, right? You have some money market instruments, right? Some of them can give you yields of even more than even 20%. Some even give you positive returns also, but you need to also balance it also. That's why you also see that some investors are even also focusing on the equities market to try and say that by the time you have your blended return, you notice that your effective return is giving you a positive return on all your assets.
Hmm. All right. So, what broader economic tremors might emerge now if banks, squeezed by high funding costs, start pulling back on lending more than anticipated?
I would say that something that we also need to also have at the back of our mind is that look, over the last 10, 15 years, the banking industry and particularly the economy, we've gone through various cycles. So what we are seeing now is not new. It's something that we've experienced before, right? And it's something that we are going to get over. And like I said earlier, luckily, we seem to be gradually getting towards the end of this particular cycle. And also another good news is that let's also not forget that banks are also going through a recapitalization exercise currently, right? Some, the CBN has approved their funds. Some, they've raised the fund, but they are waiting for approval from the CBN and the Security and Exchange Commission before those funds are released to them. By the time the banks have such funds, you notice that the liquidity pressure of such banks is going to actually even reduce. Because for all the one that we're saying, now you notice that there are some banks that even the interest rate on their deposits is not that high because CBN has released the funds that they've actually raised for them, and it seems to have relatively lower liquidity pressure. So for the banks, right, like I mentioned, two things. One, by the time the CBN released the capital raise, right, then the pressure will reduce a bit. But at the same time, also, at the next MPC meeting, my expectation is that the worst case scenario is that this particular rate will be retained. I don't see it at the CBN tightening further, right? Given that we are seeing the data in terms of inflation that is gradually trending down, and the CBN can also see how effective some of these their policies have been in taming inflation and moderating the volume of funds that they have in circulation.
All right, so I think we just put it at that. I mean, we see banks who are going through economic pressures into the policies of government. Individuals are also feeling the impact of these policies, and everyone is just, trying to media around the pressure and stay afloat. But then one would actually hope that there could be sort of balance in what is, achievable for these banks without having to turn to commercial papers to actually stay afloat, and of course have the liquidity that they can use to drive operations and probably make loans available to those who are in need of it. But I will continue to monitor the trend and see what obtains in the next probably few weeks. Ayokunle Olubunmi, Head of Financial Institutions Ratings at Agusto and Company. Thank you so much for sharing your thoughts with us.
Thank you, Lekon. Thank you for having me.